Welcome back to Investing Talk Podcast.
Today we're looking at Microsoft.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm know we're here.
Right. So let's set the scene a bit. It is late February 2026, and the markets have been, well, jittery feels like an understatement.
Jittery is definitely polite. I'd say schizophrenic at this point. I mean, we are looking at Microsoft stock trading around $415 right now.
Which is a pretty significant drop.
Yeah, that is down roughly 18% year to date. For a company that was flying high above $480 just before earnings, that is a serious haircut. That's deeper than a standard correction. It feels like a statement by the market.
It really is a statement. And that's the big so what for today's discussion. We need to figure out what that statement actually means. Is this a falling knife, like a warning sign that the AI trade is finally unraveling and the bubble is popping?
Or is this a golden opportunity to buy a cloud giant at a steep discount while everyone else is just, panicking in the streets?
Exactly. And that is the multi-billion-dollar question. Because the whole thing hinges on whether their massive AI bet is actually paying off in hard dollars.
Right, or if it's just burning cash. Because I'm naturally skeptical here. I see the hype, I see the headlines every single day, but I want to see the return on investment. If they're spending billions on these data centers, I want to see billions coming back in actual profit.
That's completely fair. And usually when a stock drops nearly 20%, you just assume the underlying business is crumbling. But when you strip away the sentiment, let's pivot to the numbers to establish the baseline, because the story there looks wildly different from the recent price action.
Okay, prove it. Walk me through the top line numbers.
Sure. So ideally, you'd want to see steady, reliable growth. For Q2 of fiscal year 2026, Microsoft reported revenue of $81.3 billion.
$81.3 billion for a single quarter.
Right. And that is up 17% year over year.
17%. Okay, I mean, for a startup, 17% is fine. But for a company the size of a G7 economy, that is a massive absolute dollar amount. But I have to ask, is that organic growth, or is there some currency magic happening there? You know how multinationals love to blame or credit the strength of the dollar?
Oh, totally. But even in constant currency, stripped of all that Forex noise, it's 15%.
Still huge.
Yeah, but the crucial part isn't just the raw number, it's the trajectory. The raw growth is actually accelerating. This isn't a slowing giant, it's a speeding one. And the engine driving all of this is the Microsoft Cloud.
The cloud is always the core story with them. But cloud is such a vague term these days. It covers everything from an Office 365 subscription to the actual bare metal servers. What are the specific numbers inside that segment?
So Microsoft Cloud revenue hit $51.5 billion. That's up 26%. But here is the specific stat that really matters, and the one that frankly shocked me when I saw it. Azure and other cloud services surged 39%.
39%? Wait, hold on. That is a gigantic number for Azure. Usually, as these cloud platforms get bigger, the percentage growth slows down. It's just the law of large numbers. Gravity is supposed to kick in eventually. How on earth are they growing a business that big at nearly 40%?
Because the entire demand curve has shifted. It's not just companies migrating their old on-premise servers to the cloud anymore. That was the old growth story. The new story is AI consumption.
Oh, okay.
Every single time you query a model, every time an agent runs a background task, that burns compute.
So this is a consumption layer built right on top of the infrastructure layer.
Exactly. But to your point earlier about skepticism, are we sure this is sustainable? Is this just a one-time bump from every enterprise trying out new AI toys in Q1 and then they'll cancel their subscriptions once the novelty wears off?
That is exactly my worry. Is this just tourist revenue, or is it real sticky business?
To answer that, you have to look at their commercial remaining performance obligation.
Okay, let's pause right there. Commercial remaining performance obligation. That is a mouthful of corporate salad. Break that down for the listener who doesn't have a finance degree. What are we actually looking at?
Fair enough. Think of it as the backlog. It represents future revenue that is already booked, contractually signed by the customer, but the service hasn't been delivered yet.
So it's recognized over time.
Right. It's essentially a crystal ball for future revenue. It tells you exactly what is locked in for the coming years.
Okay, so it's the massive IOU pile from customers. How big is the pile?
It is at $625 billion.
Wait, $625 billion? With the B?
Yes, with a B. And that number is up 110%.
That's absurd. That's more than the GDP of a lot of countries.
It really is.
Yeah.
And that massive number is exactly why the tourist argument fails. That shows incredibly sticky long-term demand. It confirms that enterprises aren't just dipping their toes in and testing AI. They are signing massive, multi-year contracts to lock this infrastructure in.
Because you don't sign a $100 billion commitment over 5 years if you're just trying out a chatbot.
Exactly.
Okay, that is undeniably impressive. I can't argue with a backlog that size. That implies the revenue floor is safe for years to come. But let's look at the bottom line. Because revenue is great, but are they actually making money on this?
Right. The profitability.
We know AI chips, like those NVIDIA H100s and the new Blackwells, are incredibly expensive. They consume a ton of power. Are they just selling dollars for 90 cents to grab market share?
That's always the fear with a new tech cycle, profitless prosperity. But look at their operating income. It's up 21% to $38.3 billion.
In a single quarter?
Yes. And if you look at the earnings per share, the non-GAAP diluted EPS came in at $4.14. That beat Wall Street's expectations pretty comfortably.
So they beat on the top and the bottom line. But I want to stick on the margins for a second. My worry is that they are spending so much on physical infrastructure that their margins should be compressing. If my cost of goods sold goes up because I'm buying tens of thousands of expensive GPUs, my margin should naturally go down.
That is logical, but it's actually incorrect in this specific case. Margins have expanded to 46.7% over the last 12 months.
Expanded? How is that possible?
Well, 5 years ago, that number was 41.6%. This just proves they're executing with incredible operational efficiency. They're finding ways to squeeze more juice out of the lemon, optimizing their data centers for power and cooling, and likely they just have enough pricing power to pass those massive hardware costs directly onto the customer.
The customer just accepts it because they have nowhere else to go. And looking at the balance sheet, it's a fortress. I'm seeing $89.5 billion in cash against roughly $34 billion in net debt. They could technically buy a massive competitor in straight cash and still have billions left over.
Or they could just keep buying back their own stock. But beyond the sheer cash, we really have to talk about the moat, the switching costs.
Right. The Hotel California of enterprise tech. You can check out anytime you like, but you can never leave.
Precisely. Once you move your enterprise data to Azure and your employees are all using Copilot inside the 365 ecosystem, which, by the way, grew 17% on its own, trying to leave is a nightmare.
It's not just migrating files anymore. It's breaking active workflows.
It's data gravity. The more data you have stored there, the harder and more expensive it is to move it anywhere else. The integration of Copilot just strengthens that lock-in tremendously. It creates this powerful network effect where the data, the apps, and the AI models are all talking to each other seamlessly.
So leaving Microsoft means breaking that conversation and essentially making your employees slower and less productive on day one of the switch.
Exactly.
Okay, so the core business is printing money. The backlog is the size of a European country, and enterprise customers are totally locked in. But the stock is still down. Let's pivot to the charts and look at the price action. Because if the fundamentals are so beautiful, why is the chart looking so ugly?
It is a fascinating disconnect. As of February 10th, 2026, the stock is sitting at $415.65.
And like I said earlier, it was well above 480 right before earnings. That 18% drop year to date is painful if you bought the local top. It feels like the market knows something we don't.
It definitely feels that way when you're in the red. But if you look closely at the chart, the stock appears to be forming a strong psychological base right near these 10-month lows. It's found a floor.
Why there? Why 415?
Because it's the point where the valuation starts to look undeniable to the institutional algorithms. You see a clear rebound signal emerging post-earnings. The stock dipped, the marks looked around, digested the actual numbers, and realized the sky wasn't falling.
But is there real momentum here? Or is this just a dead cat bounce before another leg down?
There is real institutional flow. While there is broader tech volatility happening right now, money is starting to flow aggressively back into diversified cloud leaders. The market was initially spooked by the high capex narrative, this idea that they are spending way too much capital expenditure on AI hardware.
Right, the blank check fear.
Exactly. But the price action suggests investors are starting to step back in, looking for a higher low. They are realizing that high spend right now is the only way to secure high growth later.
So the smart money might be treating this as a massive discount. Now, let's look at what the market is actually feeling with the sentiment score. Because price action is one thing, but the overarching mood is another entirely.
Currently, the quantitative mood is mixed neutral. It's a real tug-of-war out there between the bulls and the bears.
What exactly are they fighting about right now?
Well, the biggest fear recently was that AI would essentially eat software. That if AI agents get good enough, nobody needs a traditional interface like Excel or Word anymore.
Right, the idea that an AI just does the work for you. You don't need a spreadsheet to run a regression analysis. You just tell the computer, analyze this data, and it outputs the result. If that happens, Microsoft's massive application layer just sits there gathering dust.
Exactly. That was the whole existential threat narrative. But we just got some major relief news regarding Anthropic.
The AI lab. The ones who make the Claude models.
Yes. The recent partnerships and integration news heavily indicate that tools like Anthropic's Claude aren't going to displace foundational providers like Excel. Instead, they are integrating directly into them. This was a major relief rally point for the stock.
So it proves that AI is an additive layer, not a replacement for the software stack we use every single day.
Exactly. Microsoft isn't becoming obsolete. It's becoming the host platform for the new intelligence. Wedbush analysts were very vocal in affirming the company's resilience here.
That makes total sense. They are the operating system for the AI, not the victim of it. And speaking of analysts, I saw some of the updated price targets.
Yeah, despite the neutral mood in the headlines right now, the series analyst models are targeting $616.
$616. That is a potential 55% upside from where we are sitting today at $415. That is incredibly aggressive. That's not just a recovery bounce. That's a multi-year moonshot.
It is aggressive, but it's mathematically based on that 39% cloud growth we discussed. Also, we have to touch on a brief leadership shift. Phil Spencer retired, and Asha Sharma is the new gaming CEO.
Gaming is obviously huge for them with the Xbox ecosystem and the Activision acquisition. But how does that fit into the larger AI story? Or is that just a side quest for them?
Oh, it's not a side quest at all. It's central to the thesis. This move signals a strategic accumulation in the overlap between AI and gaming.
How so?
Think about non-playable characters. NPCs powered natively by large language models. Characters you can actually have open-ended voice conversations with, or dynamic world building where the game engine creates the environment in real time as you play.
That would require a staggering amount of compute.
Exactly. It's another massive, virtually untapped growth vector for Azure compute demand.
Wow. And then there's the rumor mill. I saw something floating around about OpenAI recently that made my jaw drop.
Yes, this is highly speculative, but it's massive if it turns out to be true. Rumors are circulating that OpenAI could potentially spend $600 billion on compute through 2030.
$600 billion. That is, that's hard to even conceptualize. That's more than the market cap of most tech companies.
It is a staggering figure.
But wait, if that is even half true, where does all that money actually go?
It flows almost directly into Azure's pockets. Microsoft is the exclusive cloud provider for OpenAI, so that $600 billion in operating cost for OpenAI is essentially $600 billion in top-line revenue for Microsoft.
That is basically a direct wealth transfer from venture capital right into Microsoft's income statement.
Precisely. It absolutely amplifies their role as the ultimate hyperscaler.
Okay, you're painting a very rosy picture here. But it can't all be good news. I want to take the other side for a minute. Let's really dig into the risks. I want to talk about Michael Burry.
Ah, yes. The Big Short himself.
Exactly. He made some pretty sinister accounting accusations recently regarding Microsoft and this whole AI infrastructure boom.
He did. And while it's a highly technical point, it's a critical one to understand.
Break it down for us. What exactly is he accusing them of doing?
The core claim is that Microsoft might be deliberately understating depreciation to hide the true cost of their AI infrastructure build-out.
Okay, explain depreciation like I'm 5.
Sure. Imagine you buy a high-end laptop for your business for $1,000. You don't count that as a $1,000 loss on day one. Say this laptop is going to last me 5 years, so you deduct $200 a year from your profits over that lifespan. That's depreciation.
Makes perfect sense.
But Burry's argument is that these new AI servers, these massive GPU clusters, are running incredibly hot. They are running 247 at absolute maximum capacity. They simply do not last 5 years. They might burn out or become technologically obsolete in 3 years.
Ah, so if Microsoft is still saying they last 5 years on their official books, but they actually die in 3.
And their profits on paper right now are much higher than reality because they aren't accounting for the replacement costs fast enough.
And the implication of that is that their current profits could be inflated by as much as 20%. That is a scary number. If you take 20% off their earnings overnight, suddenly that PE ratio looks way too high.
It is a completely valid concern. It's essentially the Enron fear, that the accounting on the spreadsheet doesn't match the physical reality in the server rack. And on top of that, there is the sector rotation risk.
Right, the boring energy narrative I've been hearing about.
Exactly. Investors are looking at the massive power consumption of these AI data centers and thinking, why buy the chip maker or the cloud host? Just buy the power plant. They are using traditional energy stocks to buffer against tech losses. There is a real fear of a broad rotation out of high-growth cloud and into value and infrastructure.
Which makes perfect sense logically. If AI needs electricity above all else, the utility company is the ultimate picks and shovels play.
Exactly.
So how do you rebut the Burry claim then? Are they cooking the books? Because if the profits are an accounting mirage, this whole bullish thesis falls apart instantly.
I acknowledge the concern, and obviously Burry is a brilliant guy. But I point to one metric that you absolutely cannot fake: free cash flow.
Cash is king, always.
You can mess around with depreciation schedules on the income statement all day long. You can tweak the amortization, but you cannot fake the physical cash balance sitting in the bank account. They returned $12.7 billion directly to shareholders in Q2 alone through dividends and stock buybacks. That is real cash leaving the corporate bank account and going directly to investors. You simply can't do that quarter after quarter if the profits are a mirage.
That is a very fair point. You can't pay a dividend with clever accounting tricks. The check would bounce.
Exactly. And with those 46.7% margins we talked about, they have a massive operational buffer. Even if depreciation is adjusted, let's say Burry is 100% right, and they are forced to write down assets much faster, and their margins drop a few points, they are still fundamentally more profitable than almost anyone else in the entire industry.
So the underlying business is just too robust for a technical accounting adjustment to derail the long-term thesis.
That's my take. The cash generation engine is just too strong.
Okay. So weighing the massive top-line growth against those accounting questions and the recent chart volatility, what is the final verdict here?
Based on the research, I'm giving this a bullish score of 9 out of 10.
9 out of 10. That is high confidence, especially with the stock down this much year to date. Walk me through the final thesis.
It really comes down to 3 pillars. First, Azure is growing at 39%. The cloud segment alone is a $51.5 billion giant. The company dominates the critical AI infrastructure layer. If you believe AI is the future of the global economy, Microsoft is the toll road you have to drive on.
And the second pillar.
The recent pullback. The 18% drop is a gift. It has massively de-risked the entry point for new capital. You aren't buying the absolute top, you're buying a healthy correction within a secular multi-year bull market.
And the third.
The moat. The Anthropic integration news proves their core software suite is safe from sudden disruption. The enterprise lock-in is very real and very durable.
You know, even as a natural skeptic, I have to concede on the free cash flow argument. And that $616 analyst price target, if they are even half right about that upside, the risk-to-reward ratio here is highly attractive for a long-term position.
That's the optimal strategy here, a multi-year hold into AI diffusion. You buy the heavy infrastructure build-out phase, you sit on it, and you let the compounding happen over the next decade.
So what does this all mean for you, the listener? It means if you were sitting on the sidelines waiting for a significant dip to finally get exposure to the base AI infrastructure layer, the market just handed you one on a silver platter.
That's the thesis for Microsoft.
Don't forget to subscribe, like, and comment to this video to support the show. We'll see you in the next one.